Hey, what's up guys? In this video, I'm going to analyze the stock of Big Lots. I'm going to use financial statement analysis and a discounted cash flow model and try and figure out a fair value for their stock and ultimately try and decide whether it's worth buying right now. If you're new to the channel, my name is Dan. I do a lot of stock analysis. So if you're into that kind of thing, hit that subscribe button so you can see more videos like this one. But alright guys, let's get started. So here is Big Lots website. They have several departments. You can buy furniture there, as you can see here. You can also shop for mattresses, patio furniture, and importantly, groceries. Alright, here is Big Lots stock. As you see, they've had quite a year here, almost doubling their stock price in the past 12 months. The stock currently trades for about $55 a share, giving it a price to earnings ratio of about 7.6, which looks very attractive. And in fact, they do pay a dividend of about 2.16% yield right now. It's about a $2 billion company, and very interestingly, there's 24% short interest in the company right now. That means about a quarter of the company's shares have been borrowed and sold short. Okay guys, so right from the beginning, I think we have an interesting stock here. 24% of their shares have been sold short. That is pretty high. So there's really two ways of looking at it. On the one hand, okay, it's probably hedge funds, it's probably large institutions selling short. Your average retail investor doesn't sell short. So you've got sophisticated investors betting against Big Lots. That would be a pretty negative signal to me. However, another way of looking at it is that, okay, the share price right now is kind of artificially depressed because of these short sales. At some point in the future, they're going to buy them back, and at that point, that's going to send the share price increasing. So if Big Lots is successful and the share price goes up, these short sellers may be forced to close out their positions. You could see a share price explosion effect, much like what we saw with Tesla in late 2019, early 2020. Not to the level of the GameStop madness that we saw recently. More of a Tesla-esque situation there. But pretty interesting situation. Let's have a look at their financials. Okay, so here is Big Lots balance sheet. I see a liabilities to assets ratio of 73%, but notice the debt to assets ratio is only 8.8%. So most of their liabilities are current liabilities, and so they don't actually have a lot of debt going on. The current ratio, 1.22, which is above 1, very good for a retailer there. Interestingly, the quick ratio is very poor, 0.16. So the quick ratio, you can see it in the description below if you don't know about this ratio. But that's kind of like the current ratio if you take out the inventory. So they really, that's running it pretty tight. You can see that with their balance sheet. They only have 1.7% of their assets are just cash. So they don't have a lot of cash available. That doesn't concern me too much because if you look at their debt to assets ratio, they can definitely borrow more money if they need to. And so because they have such low levels of debt, their interest coverage ratio is almost 30. So that, they're really in no danger, no solvency issues here. A little bit of a liquidity concern. I could see them having to borrow some money, but they can afford to. Okay, so here I'm doing a vertical analysis for Big Lots. That's when I take a bunch of income statements and divide every number by revenue. So for example, I'm looking at R&D expense. Okay, that's 0% of revenue for all years. Selling, general, and administrative expenses look to be a pretty consistent, around 32 to 34% of revenues. So it's just a nice way of looking at things, and you can see where the money goes. What I see here is a very, very healthy gross profit margin, close to 40%, pretty high for a retailer. And in fact, their operating margins are decent too, anywhere from 4 to 5.7% on average. What that means is for every dollar of sales, after paying for their operating expenses, they're able to generate between 4 and 5.7 cents of profit. Now, because of income taxes, their bottom line here, net income margin, is a little bit lower most years. You're looking at, 2.2, maybe close to 3, 3.6, all the way up to 4.6%. In the trailing 12-month period, it is actually 10.3%. I do not expect that to continue. That was caused by an unusual item here. If you look at their earnings before taxes excluding unusual items compared to including unusual items, you can see some weird gain there caused that. So don't think that's going to continue. Okay, so with more of a focus on how they generate their profits, I'm looking at a DuPont analysis. You can check out my video in the description below. But essentially, we're looking at return on equity and its three components. So Big Lots is very typical of a retailer. You see a massive asset turnover there, always above 3. So for every dollar of assets in place, they're able to generate $3 in sales every year. Now, they don't make a lot of money on per sale. That's where the net income margin comes in. So net income margins actually decent for a retailer, getting all the way to 4.6% there. But that's not really how they make their money. They make their money by selling lots of stuff. Now they have a little leverage here. You can see with the equity multiplier. So they're able to generate pretty healthy return on equity numbers there. Looks to be around 20 or 25% most years. Again, I like the way it's going there in the February 2020 report. I would note again the trailing 12-month period, 90% ROE, probably not going to happen again. We have some kind of unusual thing causing the net income margin to be abnormally high that year. But even if you ignore that year, you got pretty healthy profitability here at Big Lots. Here are payouts to shareholders over time. And what you'll notice is that Big Lots really has not paid dividends, if you look in the blue there, until very recently, where they paid a dividend in 2020 and they're continuing that in 2021. In the red, though, you will notice they've bought a lot of their shares back. These are in millions of dollars, so they spent about $350 million in 2017. They spent about $250 million in 2018. So they're spending quite a bit of money buying their own shares back, which is another way of rewarding shareholders. Okay, so very related to dividends and buybacks are the payout ratios. In blue, I have the regular payout ratio. That's your dividends paid divided by net income. Again, it's pretty much 0 because they didn't pay any until recently. But, even recently, it's just 11.5, 6.2% of their profits they're paying out. So that dividend is very safe if they want to keep paying that. In the green, we're looking at the modified payout ratio, where you take dividends plus buybacks and divide it all by your profits. So for that, I have to say their buybacks are probably going to slow down because, as you see here, they've been buying back more than they actually made in profit. But again, I think the important thing to note here as a shareholder is that dividend is very safe and will probably grow. Okay, so here I'm looking at days in inventory. This is the average number of days your inventory sits in your stores before it's sold here. And so for Big Lots, it's a little higher than I would like to see. You're looking at, 100 days, a little bit more than 100 days. Recently it's really taken a sharp dive down here, dropping from about 105 to about 94 days. That's pretty impressive, and I'd definitely like to see that. Here is total revenue in millions for Big Lots, and they're really not a growth company. If you look at it, they sold about $5 billion worth of goods in 2012, which is very close to the amount they sold in 2020. Now, in the trailing 12-month period, their sales have really skyrocketed. But, we did have a pandemic, a lot of people ordering online at Big Lots and other places like that. No one being able to eat at restaurants. And remember, Big Lots does sell groceries. It's hard to say whether this is going to continue. I would say, not likely. So, but again, they're only trading at about 7.5 times earnings. So we don't really need a lot of growth to buy the stock. Alright guys, so at this point in the video, I want to use an intrinsic valuation model to value Big Lots and try and figure out whether it's a good time to buy or not. To do this, I'm going to use the free cash flow to equity model. Now, because Big Lots is not really growing by much at all, if any, I don't think I really need to have a detailed 10-year forecast to map out the path for growth, like you saw me do maybe when I was valuing a company like Adobe or ServiceNow or a company like that. Nevertheless, I will assume some kind of growth rate in free cash flow to equity over the next 5 years. I'll show you guys how the value would change if I change that growth rate, and we're just gonna come up with the value for Big Lots. I will use a discount rate of probably about 8%, maybe 9%. I think it is a retailer. It's not a large retailer. It's only a $2 billion market cap, so it definitely carries risks with it. You know, that being said, it's not like a lot of these young startup companies that don't even have profits yet. You know, Big Lots has been in business for a long time. They definitely generate profit every year. They're not really a sexy tech company or anything, but you know, they make their money, so I don't think they're overly risky to the point that I want a 10 or 11% discount rate. So let's put some numbers to it and let's see what the value of Big Lots is. Alright guys, so what we're looking at here is a valuation matrix. Every cell here represents the fair value for a share of Big Lots, assuming a given discount rate or required rate of return, and a given growth rate in free cash flow to equity over the next 5 years. Now, for the very next year's free cash flow to equity, I'm assuming that's going to be $214 million. I got that number using the revenue forecast for the next year, multiplied that by the profit margin. The profit margin, I just took an average of the past 5 years or so, about 3.9%. So assuming that's the case, the stock could be worth a variety of values here. For example, if you want a 9% return, that's the discount rate you think is appropriate, and you think Big Lots can grow their cash flows at 2% per year for the next 5 years, and after that time period, they just grow at 1% in perpetuity. If that's the case, the stock is worth $60.81 per share. For me personally, I'm more in this row here. I don't think a higher discount rate than 8 is really necessary. And, you know, probably somewhere between these two cells, just kind of assume a 0% growth rate. But either way, the stock would be undervalued. To get a better sense of whether it's over or undervalued relative to the price today, have a look at that matrix below there where I highlighted green if it's undervalued, red if it's overvalued, and I give you a percentage relative to the price today. So for me, by the numbers, it does look like a good deal. Here is insider trading activity for Big Lots. Really not much going on the past 3 months. One insider has sold shares, no one has bought any. We have some activity in the past 12-month period though. So yeah, that one insider sale is really not a material amount of shares there. What's interesting is that in the past year, you've had a lot more insiders buying relative to insiders selling, but that is a rather old signal. Remember, Big Lots share price has about doubled in the past year, so, I can't really say that that signal is still valid. So for me, not much information here. Alright guys, here are my final thoughts on Big Lots stock. Number one thought is that they have an incredible balance sheet. It's almost perfect. They have a little issue there with the quick ratio, but being that they are a retailer, being that their debt levels are so low, I'm not really concerned about that. So I give them a B plus or A minus for that balance sheet. Number two is I love their profitability. When I looked at Big Lots originally, I don't have any Big Lots around where I live. I don't really know if anyone shops there, so I didn't really know what to expect. But you can't argue with these numbers. Even through the pandemic, because of online sales, they've kept their revenues coming in. And this is a company that has asset turnover ratio of above 3 in pretty much every year. So they generate revenues, they generate profit, and they're trading at 7.5 times next period's earnings. You gotta like the company. And when we do the discounted cash flow analysis, it does look like a good deal, even when we assume that they're not really going to be growing their cash flows at all for the next 5 years. So, for me, even under pessimistic assumptions, it's still undervalued. It's definitely undervalued for me. I am going to buy some stock in Big Lots. Let me know what you think in the comments below. Always appreciate your feedback. Thank you guys so much for watching.